Hey guys, what is happening? We're going to talk about some accounting stuff. I'm Jay. This is smarthelping.com. We're going to talk about balance sheet and the PIK loan, or interest-only loan that accrues interest and then refis at the end of the interest-only period. And how do you balance it on the balance sheet and take into account all of the effects? So let me pull up. I put this into a recent financial model template I built. This wind farm. It's also in a couple other ones. I think the laundromat advanced version. So we want to say, there's loans here. This is a situation where, we've got construction periods happening with different deployments. There's some amount of the construction cost that's getting financed. So there's an option to turn on or off a PIK loan, payment in kind, which just means the accrued interest is applying to the principal. It's getting capitalized, and then you're paying interest um, in the form of increasing the loan balance, and then you refi at the end of the loan period. Boom, and now you got a P&I payment to the end. Okay, so there's a lot of stuff with these formulas going on here with the amortization, but what I just want to talk about is how you take this information and correctly apply it to the balance sheet with non-current liabilities. So let's just look at a single example that'll make this a lot easier. Make sure I don't save this base template. I'll put this as a test. Okay, so we just want one. Let's clear all this stuff out. Don't care about any of this. Um, Actually, all we really had to do was zero out the loan to value here. Okay, so now all these other loans are zero. We also want to zero out these operating loans. And I find debt logic to be one of the most difficult things to model. It's difficult for a lot of reasons. But it's definitely very useful to have in a model. Um, Let's also, you know what? Let's try to zero out everything besides the loan effect and see if we can do that. Let's just see if we can clear everything out. Well, we'll leave the first one in there. Okay. Just clear off everything. No revenue. I just want to see only the effects of the loan, and so I just have to zero all of this stuff. Clear it all out. Okay. That's clear. Staff. Now, we should have, oh, what's this? Okay, these are construction costs. So this is the cost of, okay, that's fine. And then this is just the minimum equity. Zero that out. Okay, this will just be a lot easier to explain if all we have going on is debt. Zero these out. Probably should have prepared that before, but it's okay. All right, so all you've got here for on the monthly detail is just the effects of that one loan. All right, so let's go over here. We have loan one, $346,000 were taken out. So, and that's sourcing from the deployment here, where it's costing us $577,000. Um, we could actually put this stuff in here. Let's say construction period was like 11 months. We're doing 5 turbines. Deployment month 1. Okay. So it's $13 million construction, 60% finance, 7.8 million is the total financing. If we go over here, the first effect is on the balance sheet. So what do we have going on the balance sheet? Well, liabilities going up because of the borrowing of the loan. But look at here, it's 7.846 million. Now, how are we getting to that? Well, it's this amount, and then this is set up so the payments start in the previous or the next month. So next month we should be 71,924 higher. Even though this interest amount is not being paid, it's the liability is going up. So here we're at 7,846. Now it's at 7,918, which should be the difference of, based on the interest, 71,924. And again, for all these 72, 73, 73, 920. So you can see that is all of these. So you've got this interest accrual happening, increasing the liability. So that's a liability going up. You also have on the income statement, interest expense. So this interest expense, it's not a cash flow item, but you are incurring the expense. So we're putting it on the income statement right there, which means we're going to affect retained earnings. Now there's also depreciation from the construction and the wind turbines. They have depreciable lives. So on the balance sheet, you're going to have retained earnings is going to equal the total interest expense plus the total depreciation expense. All we care about for the loan effect is you've got interest expense raising the liability and lowering the equity retained, which is in the form of the retained earnings account. So assets always equal liabilities plus owner's equity. In this case, you've got liability going up and owner's equity item going down, so that balances to 0. Now you also have to balance the cash here. So we have 13,435,000, which is going to be borrowing of the debt. Cash goes up, and then this is just some fillers for owner's equity and the capex item. But look at here, we have to add back that interest accrual that's happening once the loan starts. So this is zeroes out to nothing. So there's actually no cash effect for these items, which makes sense. It's a non-cash item. But once the loan actually starts getting repaid, now you do have interest happening. You're no longer zeroing that out, and all this stuff is happening dynamically. You're also paying back some of the loan principal. And now on the balance sheet, you can see the liability will start to go down once that begins. So here you're at 8.287, then you're at 8.280, 8.274, etc. You're paying off the loan here. Once that happens, there's no more, well, the retained earnings will still go down by the interest. The cash flow is going to go down by the principal amount. You can see that happening here. And the principal amount and the interest amount are affecting the cash flow for the period. You've got a check here to make sure assets always equal liabilities plus owner's equity. So this is just one little aspect of financial modeling with a 3-statement model. There's a lot of other stuff going on here, but usually the part that people miss is on the PIK loans is adding the accrued interest to the liability balance while it's interest free but accruing. Now you could have a loan where, let's say, this wasn't accruing, it was actually being paid. In that case, it would just be like a regular interest payment. All right, well, that's all I wanted to touch on. If you want to get a hold of this template, let's see, you can go to smarthelping.com and I've put this template in the one I just went over was the wind farm. It's actually right at the top of the industry specific. Right here, $65 one-time fee to download the template and use it as you wish. It's also part of the industry specific bundle for $2.99, which is a license to all these templates and everything I ever add to the bundle. And if you really want to get fancy, you can go to download the full library under the All Financial Models tab at the top. Click that. You can get everything I've built. I do this for a living for the past 9 years. I've been building these financial model templates. And you can get everything I've built for $9.99. And that includes access to everything I ever build in the future. If you want to review the templates, click the little review templates link here. You can review everything I've done. Each link has a link to the model, a video overview, and screenshots of the templates. And there is a lot of stuff here for a lot of different industries, and just so much value because there's literally a million things you can do in a spreadsheet. And this is all related to kind of finance and business management tools, financial modeling. So check it out. I also do billable work at $195 an hour. So if you want to hire me to work on anything, I'd be happy to do that. I could build financial models from scratch based on your specs. I could modify spreadsheets, check spreadsheets, build all kinds of stuff. I don't just do financial modeling either. I do, let's say you wanted to build a little CRM for a real estate company that's trying to track deals over time, and you want a little database to see like different statuses of deals, or maybe a customer CRM where you have larger customers and not a ton of them. Usually Google Sheets is really good for doing dealing with stuff like that. Alrighty, like and subscribe. Hopefully this helped you. Three statement modeling is tough. It's a puzzle, and I just went over really some nuances to a PIK loan on the balance sheet and trying to balance it out. Alrighty, take it easy.